Imagine hearing the sound of an emergency. Everything is urgent, decisions need to be made quickly, and every second counts. That's exactly how the market feels when opportunities appear and disappear in a flash. But with the right tools, like RSI combined with powerful indicators, you can stay calm, take control, and make the right moves. Today, I'll show you how to use this life-saving combination in your trading strategy with real market examples. Stick around for a quiz at the end to test your understanding. Don't forget to subscribe for more valuable content. Let's dive in. 1. RSI plus moving average. What is a moving average, MA? A moving average is a fundamental tool in technical analysis used to smooth out price data over a specific period. It calculates the average closing price of an asset, such as a stock or cryptocurrency, over a defined number of days, weeks, or even minutes. For example, the 9-period moving average, commonly referred to as MA9, is a short-term moving average, which calculates the average closing price of an asset over the past 9 periods, such as days, hours, or minutes, depending on the chart's timeframe. By doing so, it filters out short-term fluctuations and noise, helping traders focus on the overall trend. Moving averages are used in various ways. 1. Identifying trends. If the price is consistently above a moving average, it indicates an uptrend, while being below suggests a downtrend. 2. Support and resistance levels. Moving averages can act as dynamic support or resistance levels where prices tend to bounce off. 3. Crossovers. The crossover of two moving averages, such as the 20-day and 50-day MA, can signal potential trend reversals. A golden cross, shorter MA crossing above a longer MA, suggests a bullish trend, while a death cross indicates a bearish trend. Now that we've explained what a moving average is, let's see how we can combine it with RSI to create a more reliable trading strategy. The RSI, as you know, helps us identify overbought and oversold conditions in the market. If you haven't watched our detailed explanation of RSI yet, make sure to check out the educational video linked above to fully understand how it works before proceeding. The moving average shows us the general trend direction, while the RSI tells us when the market might be overbought or oversold. By combining these two, we can filter out false signals and increase our chances of successful trades. Here's how it works. First, look at the moving averages to determine the overall trend. For example, if the price is above the moving average such as 50-day, the market is likely in an uptrend. If the price is below the moving average, the market is in a downtrend. Once you have identified the trend, it's time to look for signals. To decide whether to focus on buy or sell signals, remember the well-known saying, the trend is your friend. This means that in a bullish trend, you should focus on buy signals, and in a bearish trend, look for sell signals. RSI is a common tool used to generate these signals. In an uptrend, wait for the RSI to dip below 30, oversold zone, and then start rising again. This could indicate a buying opportunity. On the other hand, in a downtrend, wait for the RSI to climb above 70, overbought zone, and then start falling. This could signal a good time to sell or short. RSI and moving averages work well together to confirm trend changes. 2. MACD plus RSI. What is MACD? MACD stands for Moving Average Convergence Divergence, a popular momentum and trend following indicator used in technical analysis. It helps traders identify the strength and direction of a trend, as well as potential reversal points. MACD consists of three main components. MACD line, the difference between the 12-period EMA, faster, and the 26-period EMA, slower. Signal line, and 9-period EMA of the MACD line. Histogram, the visual representation of the difference between the MACD line and the signal line. How to use MACD? 1. Crossovers. When the MACD line crosses above the signal line, it indicates bullish momentum, a buy signal. When the MACD line crosses below the signal line, it indicates bearish momentum, a sell signal. 2. Zero line. If the MACD line is above the zero line, the trend is likely bullish, signaling upward momentum. If the MACD line is below the zero line, the trend is likely bearish, signaling downward momentum. 3. Divergences. The MACD histogram can help identify divergences. A divergence occurs when the movement of the histogram differs from the movement of the price, signaling a potential trend reversal. Now that we've explained what MACD is, let's see how we can combine it with RSI to create a more robust trading strategy. The RSI, as you know, helps us identify overbought and oversold conditions in the market. The MACD, on the other hand, shows us the momentum and direction of the trend. By combining RSI and MACD, we can confirm signals and filter out false entries, improving the reliability of our trades. Here's how it works. First, check MACD to analyze the trend direction and momentum in the market. When the MACD line is above the signal line and the zero line, the market is likely in a bullish trend. When the MACD line is below the signal line and the zero line, the market is likely in a bearish trend. Once we've identified the trend, focus on buy signals in an uptrend and sell signals in a downtrend. As we've already explained in the moving average section, RSI helps us identify overbought and oversold conditions to time our entries. Use the same logic when combining RSI with MACD for entry signals. Real market examples. This is the euro to US dollar chart on a 60-minute or 1-hour time frame. We use two moving averages with periods of 10 and 30 to determine the trend type. When the 30-period moving average crosses above the 10-period moving average, it indicates a bearish trend. Since the trend is bearish, we look for sell signals. When the RSI crosses below the 70 level, a sell signal is generated. In the next example, we use RSI and MACD on Tesla's daily chart. First, we identify a bearish trend with MACD when the MACD line crosses below the signal line and histograms are below zero. Then, a sell signal is triggered when RSI crosses below 70. Are you ready for the quiz? Make sure to pay attention and answer thoughtful. In the chart below, is the buy signal valid? Note that the 10-period moving average, MA10, has crossed above the 30-period moving average, MA30, and then the RSI has broken above the 30 level. Yes, that is correct. The 10-period moving average being above the 30-period moving average indicates an uptrend, so we should look for a buy signal. The RSI crossing above the 30 level is a valid buy signal. As observed, the price has increased following the signal. Alright, everyone, we've reached the end of this session. In the next session, we'll talk about trading strategies based on RSI trendline breakouts and the use of the 50 level, so make sure to stay tuned. If you enjoyed this video, don't forget to like, leave a comment, and subscribe to the channel. Your support means a lot.